Hey everyone, and welcome to this explainer. Last year alone, consumers lost literally billions of dollars to hidden banking fees and totally stagnant interest rates. It's crazy. But today, we're doing a full audit of your day-to-day money management to make absolutely sure you aren't leaving any of your hard-earned cash on the table. Whether you're just tired of mysterious fees quietly draining your balance, or you're simply looking to optimize your whole setup for the digital age, you are exactly in the right place. We're going to build a practical roadmap for your financial life, brick by brick.
Okay, so here's our agenda for today. We're going to cover 1. Choosing your financial home. 2. Checking versus savings accounts. 3. Navigating the digital dashboard. 4. How to avoid banking fees. And finally, 5. The banking jargon buster. Let's dive in.
All right, starting with section 1, choosing your financial home. So when you're laying the groundwork and picking where to put your money, you're usually looking at commercial banks or credit unions. Commercial banks, well, they're for profit, and that often translates to really cutting-edge digital apps, which are funded by their shareholder margins. But credit unions, they're nonprofit and member-owned. They actually funnel their profits right back to you. That's exactly why you'll often spot them offering slightly higher yields on your savings and lower rates on things like auto loans. We just want to give you these facts straight so you can make a completely informed choice for your daily driving. Moving right along to section 2, checking versus savings accounts. I always like to think of your checking account as a busy transit hub. Your money is just in constant motion, through debit card swipes and everyday transactions. But your savings account, that is the vault. Commingling these two is actually a super common mistake. Keeping your funds strictly separated is what protects your wealth from daily card skimmers and, let's be honest, mindless spending. Now, the real magic of a savings account comes down to interest earnings. It's not just a holding pen for your cash, it's honestly like a silent employee. When you let your money sit securely, compounding interest works quietly in the background. It transforms a static pile of cash into an active wealth-building tool. Okay, let's shift gears to section 3, navigating the digital dashboard. Look, your smartphone is essentially a 24/7 bank branch sitting right in your pocket. Having real-time balance monitoring is a total game changer. It prevents blind spending dead in its tracks. Then you've got online bill pay, which automates your monthly overhead and completely removes human error. And of course, digital fund transfers let you slide money between checking and savings instantly, keeping your cash exactly where it needs to be at all times. Which brings us to the obstacle course of our roadmap, section 4, how to avoid banking fees. Get this. Banks make billions of dollars a year entirely off these 3 silent wealth drainers. You've got ATM fees, which literally penalize you just for accessing your own cash out of network. Then overdraft fees, which hit you right when your balance dips below zero. Talk about kicking you when you're down, right? And maintenance fees, well, those are essentially just a subscription charge for the sheer privilege of letting the bank hold your money. So, seeing all these incredibly frustrating hurdles, we really have to ask ourselves, how do we completely bypass these drains on our savings? Well, the easiest way to win this game is to just automate your defense. You can leverage your digital dashboard to set up automatic low balance alerts. That stops an overdraft before your card even leaves your wallet. Also, use your bank app's locator to find free ATMs, so you aren't paying $5 just to withdraw 20. Seriously, with just a few quick toggles on your phone, paying bank fees becomes completely voluntary. And finally, we've got a quick rapid-fire sequence for Section 5, the banking jargon buster. First up on the block is APR, or annual percentage rate. Basically, this is the true comprehensive cost of borrowing money over a year because it bakes in both the interest and the fees. Listen, if you're using a credit card or taking out a loan, APR is your enemy. You want that number as close to zero as humanly possible. Conversely, we have APY, which stands for annual percentage yield. While APR is what you pay, APY is what you earn. It factors in the absolute magic of compounding interest over a whole year. So when you're shopping around for savings accounts, APY is your best friend. The higher that number is, the better. And wrapping up our jargon, we have direct deposit. This is the electronic pipeline that routes your paycheck instantly and safely right into your account. And beyond just the convenience of skipping that long teller line, a lot of banks will actually waive your monthly maintenance fees just for setting this up. It's a total win-win. As we wrap up this explainer today, I want to leave you with this one vital question. Are you making your money work for you, or are you just working to pay your bank? By optimizing your financial home, mastering your digital dashboard, and playing some solid defense against those sneaky fees, you can literally turn a passive account into an active wealth engine.
The practical roadmap is entirely in your hands now. So, what's your very next move?